Hi, it's Nishi. Hope you had a really good day. And in today's video, what I want to talk about is how tax works when you actually sell your business. So, if you're one of the few people who actually do go ahead and try and sell your business or do sell your business, then this is something that's worth understanding because there's two main ways to sell your business. There are other minor ways, but the main two are what we call an asset sale and a share sale, and I'll just talk you through both of them. It's a quick video, but I just want to understand the pros and cons of each one. So one of the most important things when selling your business is negotiating with the buyer and working out exactly how you're going to sell it, because ultimately what happens is if your business, which if you're selling it, the chance are it's a limited company business, your business probably sits within a limited company, and then you've got two options. Do you just sell the goodwill and the assets straight out from the limited company so you're still the owner of that limited company, or do you actually sell the shares in your limited company so you're no longer the owner of the limited company? So the first one I mentioned, where you sell the assets and the goodwill out of your limited company and all the money is still left over in your limited company, it's probably the least tax efficient way, because what happens is you've just made a profit on selling a business which is still within your limited company, so you're going to end up paying corporation tax on that profit, and then you're going to have your whatever's left after corporation tax left in the company, which you then need to get out of the company, so you could end up paying capital gains tax again. So that's selling an asset out of the limited company and continuing to own a limited company is usually the least preferred way for the seller of a business. But the alternative to that is where you just sell the shares in your business. Then what will happen is if you've made a profit on your business when you sell those shares, then you don't have to pay the corporation tax on that profit, because it wasn't a profit made within your business, it was a profit made on you personally. So all you end up doing is paying the capital gains tax instead. So one scenario I've talked about there is you end up paying corporation tax and capital gains tax, and the other scenario is you only end up paying the capital gains tax. So you might be thinking, well, that's a no-brainer, right? Why would someone not just sell the shares and be done with it? Well, what normally happens when it comes to selling a business is you end up in a position where the buyer of the business doesn't want to take the shares in the business. They would much rather have the asset purchase, and the reason for that is a limited company, quite often it can have skeletons in the closet, something that happened a long time ago that the buyer isn't responsible for but will be responsible for once they own that company. So quite often there's this balance between finding what the buyer wants in terms of no pre-existing liability, and what the seller wants in terms of being able to just offload those shares at a much lower tax rate. So, and quite often in negotiations there is a premium paid if when an asset purchase, when the share purchase is going on, because people will, or the person selling the business might have to give certain indemnities to say, okay, well, if something does come out of the woodwork for this company, I'll still deal with it even though I'm no longer the owner. So this is just something that's worth understanding. In general though, like when you sell a business, like up to £1 million in terms of the profit that you made on selling that business, you can actually just claim what we call entrepreneurs relief on, which is a flat 10% tax rate. And then anything over £1 million, you go to your usual tax rate on the sale of a business, which is 20%. So first million, 10%, after that 20%. And it's definitely worth thinking about, because one day if there's not much you have to do in terms of just getting your business ready for sale, then quite often when you do sell the business and make a profit on it, you get to keep a lot of that money just because of those really generous reliefs in terms of entrepreneurs relief. So if you're watching this and you find that useful, if you are thinking of potentially selling your business, or more importantly, you want to get your business in a position where you can sell it, then that's something we can definitely help you with in terms of working out what the margins and the pricing model and the volumes and the business model in general looks like. And if you just want a bit more information on this, then definitely reach out and get in touch. So I'll see you at the next video.